ETFs are supposed to be the safe bet for British investors, right? Well, not always. One small slip and your safe ETF can quietly drain thousands of pounds. I know this because I fell into the same trap. I thought I was playing it smart, tracking the indexes, diversifying, avoiding stock picking stress, but the truth is, most investors, without even realizing it, are making simple ETF mistakes that cost them years of growth. But what I didn't anticipate was by changing one of these mistakes, it actually turned out to be the move that doubled my net worth. And it's not the one you'd expect. Okay, so mistake number one, overlooking ETF fees. You might look at a fund with a 0.75% annual fee and think, that's peanuts. But over time, those peanuts turn into entire peanut farms. Here's the math. Let's say you invest £50,000 for 20 years and your ETF grows at 7% per year. With a fund charging 0.75%, you'd end up with about £176,000. Not bad, right? But if you'd chosen a similar ETF charging just 0.07%, like Vanguard's S&P 500, you'd have about £193,000. That's a £17,000 difference for the same strategy, the same index, just cheaper fees. And that's just the ETF's internal fee, called the ongoing charges figure. On top of that, your platform might charge you dealing fees or account fees. For example, Hargreaves Lansdown charges 0.45% annually, capped at £45 for shares, but uncapped for funds. AJ Bell charges a flat £10 per trade. Freetrade has a flat monthly fee for ISAs. Trading 212 and Invest Engine both have zero account fees, meaning you get to keep more of your gains. If you want some freebies, check the links in the description. With Trading 212, you'll get a free fractional share, and with Invest Engine, there's a welcome bonus worth up to £200 when you sign up through my link in the description below. These little charges seem harmless, but stack them together and you're giving away a slice of your returns every single year. But the fix is simple. Always compare the OCF and your broker fees before you buy. Cheapest isn't always best, but if the two ETFs track the same index, why pay more? The second mistake is skipping tax wrappers like ISAs and SIPs. In a normal general investment account, you pay tax on dividends over £500 per year as of April 2024, and capital gains tax if you sell and make more than £3,000 profit annually. That can add up quickly. Imagine you've got £30,000 invested in ETFs. A 3% dividend yield means £900 in dividends. Subtract your £500 allowance and you'll pay tax on £400. At a basic rate, that's 8.75%, so about £35. At the higher rate of 33.75%, that's £135 every year. And that's just the dividends, not the gains. Now compare that with holding the same ETFs inside a stocks and shares ISA. Suddenly, all dividends and all gains are completely tax-free, forever. You could turn £20,000 into £500,000 and not owe a single penny in tax. It's a similar story with SIPs for retirement, though they have stricter withdrawal rules. This is precisely why the ISA is my favoured vehicle for investing. Before investing in a normal account, ask yourself, have I maxed out my annual ISA allowance? If not, you're giving the taxman a tip for no reason whatsoever. Mistake number 3, not understanding ETF structure. ETFs are not all built the same. And if you don't understand the small print, you could end up with an ETF that behaves very differently from what you'd expect. Firstly, there's physical versus synthetic ETFs. A physical ETF actually buys the underlying shares. For example, a FTSE 100 ETF literally holds the 100 companies in that index. A synthetic ETF doesn't. It uses swaps and derivatives to mimic the index. Most UK brokers stick to physical ones, but some niche ETFs are synthetic. It's not evil, but it adds extra complexity and counterparty risk, which can be unnecessary for most people. Second, and more important for everyday investors, is the difference between accumulating and distributing ETFs. An accumulating ETF automatically reinvests your dividends back into the fund. A distributing ETF pays them out into your account as cash whenever a dividend is issued. It sounds small, but it can make a big difference. Let's say you're 30 years old, investing for your retirement. If you chose a distributing ETF, you'll get those dividends in cash. Unless you manually reinvest them every time or you have an automation set up, you will lose the compounding benefit of those dividends. But if you were to pick the accumulating version, The dividends are reinvested automatically, and compounding works like magic behind the scenes, and you haven't had to do anything. On the other hand, if you're 60 years old and you actually want income to spend without selling your underlying shares, a distributing ETF is perfect. One isn't better than the other, but not knowing the difference can leave you scratching your head, wondering why your account doesn't look the way that it should. Mistake number 4, chasing performance. This one even trips up seasoned investors. We love to chase what's hot. It's just human nature. You see the S&P 500 up 20% in a year and you think, I need a piece of that action. But markets don't move in straight lines. Look at the Nasdaq 100, for example. After the dot-com bubble in the year 2000, it took 15 years to get back to its old highs. Imagine buying right at the very peak because it looked unstoppable. Or closer to home, the FTSE 100 had a roaring run in the late 90s, then went basically nowhere for 2 decades when you factor in inflation. The problem is called recency bias. We assume what just happened will keep happening. But studies like the Spiva report show over 80% of funds and managers underperform their benchmarks over a 10-year period. Chasing last year's star performer is like joining a party right as everyone's leaving. The smarter move is to set a plan, choose your ETF, and stick to it. As Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. Mistake number 5, too narrow or too broad. This is the Goldilocks problem of ETF investing. Some people go too narrow, others go way too broad. On one side, you've got the niche collectors. They buy a clean energy ETF, a robotics ETF, a space exploration ETF, and a blockchain ETF. Suddenly, their portfolio looks like a science fiction book. Sure, it's exciting, but it's also dangerously concentrated. If one sector crashes, like clean energy did in 2021, your portfolio tanks. On the other side, you've got the collector of collectors. They own 10 global ETFs, 5 regional ETFs, 6 bond ETFs. But when you look closely, they all overlap. They basically own the same Apple, Microsoft and Shell shares multiple times across each of the ETFs. That's not diversification, that's duplication. The sweet spot is a core satellite strategy. You pick 1 or 2 core ETFs, like an all-world ETF, S&P 500 or Nasdaq 100. Then if you want to add a couple of small satellites, maybe a sector or a region you believe in, that way you can get diversification without the clutter and focus without overexposure. Mistake number 6, forgetting currency and withholding taxes. Here's one many UK investors don't realise until it's way too late. A lot of ETFs are listed in US dollars. That means if the pound weakens, your returns look great. But if the pound strengthens, your ETF could go down even if the underlying index goes up. That's called currency risk. On top of that, there's withholding tax. If you buy a US domiciled S&P 500 ETF directly, the US government automatically takes 30% of your dividends. That's money you'll never see again. But if you buy an Irish domiciled UCITS ETF, like Vanguard's VUSA, that withholding tax is cut to 15%, thanks to tax treaties. Over decades, that difference compounds into thousands. So the fix is simple. As a UK investor, always make sure your ETFs are UCITS compliant and ideally domiciled in Ireland or Luxembourg. They're built for British and European investors, like us, and avoid unnecessary tax leakage. Okay, so that was a lot to remember, but if you can avoid these traps, your ETF investing journey will be a lot smoother. It's not about being clever, it's about not being careless. So here's my challenge for you. Take 10 minutes today, look through your portfolio and ask yourself, am I making any of these mistakes? If you spot one, fix it now. Trust me, the future you will thank you. If you enjoyed this video, don't forget to like, comment and subscribe, as this really helps out this channel and helps me keep making more content. If you're ready to go deeper, I've put all my ETF videos in one easy playlist. Everything I've learned in one place, just for you. Hit play and check it out now.